Joining me now, Evan Lucas, Chief Market Strategist at InvestSMART. Evan, good morning to you. So let's talk about the latest news that's come out of the US. The Fed Reserve has cut its interest rates by 0.25%. What's your thoughts on this?
Yeah, third time in 2019. If you had asked me that question at the start of the year, it was a complete opposite thing. They were still forecasting the possibility of four rate hikes. So what a turnaround that certainly is. And if you listen to what they're saying, the markets have read it all different ways. So the US markets have actually jumped to a record all-time high at the close of the market today. The Fed came out about an hour before it finished, and they take it out of the idea that they're actually going to be looking at making sure they reach their inflation target, which is 2%. They currently sit around about 1.5 to 1.6% in terms of where their inflation sits. So there is a bit of room to move there, possibly. However, most economists and most bond markets took it as the idea that this is their third and done. And that the reason for that is that they have certainly removed the idea that monetary policy will be further required to actually continue growth. They've removed their idea that they are ready to move. So they now believe they're in a really happy space. It's another interesting thing about this meeting is that we didn't get the kind of information they normally give us. We didn't actually see what we refer to as their dot plots, which is where every member on the board actually tells us where they see rates by the end of 19, 20, 21, and then the longer run average. So we didn't get as much information, but it was interesting. It is as expected to see the cut, but the expectation now is that maybe we're going to see them on hold for a significant period of time, and that therefore means markets will have to sort of ask the question where that leaves them going forward.
Why the need to do that though, Evan? I mean, unemployment's at 50-year lows, inflation is moderate, and as you mentioned there, the GDP, about 1.6%, which is okay. You know, so why the need to cut the rate?
Yeah, you're right, Pete. And look, this is the question that's probably been put to the Fed all the way through the year, is that they've almost been dragged to this point, sort of slightly kicking and screaming. There are signs of slowdown. So if you look, their GDP came out on Tuesday. Their quarter was 1.9%. Business investment was weakening, and that was possibly for it. If it wasn't for the US consumer, it probably would have been weaker still. Net exports are almost basically on a neutral footing. Government spending has been reasonable in the US, but is starting to slow down as the federal government doesn't spend as much as probably forecasted. So all that is there. There again, like us here in Australia, and what the RBA tells us, it's more of the global factor. It's more around this global slowdown, the overall sentiment that comes with that, the fact that they aren't seeing the amount of take-home pay as they were expecting. You know, wages over there are quite reasonable, but they are slowing. It's about 2.3% rather than the midway through the year when it was 2.7% growth. So it seems like the Federal Reserve, the RBA, most central banks trying to be ahead of the curve this time rather than sort of waiting for the data to tell them. And that's probably what's happened with us here in Australia as well, is trying to be making sure that, in 12 months' time, when this slowdown possibly does hit, that they've already allowed the economy to sort of try and buffer itself from that harder landing.
Okay, so what does that rate cut in the US mean for us here in Australia?
This is the other part of it, and it's a great question because, again, you need to understand that all global markets are linked in a very, very strong way. Globalisation is here and has been here for 30 years. So for us here in Australia, what it means, it brings it back down to the household, because our banks in our country have to borrow from overseas. There isn't enough free capital in Australia to actually lend out to all the lenders that are here. So it means about a third of our banks actually borrow overseas. So a lowering of the federal funds rate means that the borrowing costs for not just Australian banks, but all banks that borrow out of the US will get cheaper. The ability, therefore, to pass it on should ramp up. The ability for banks to, therefore, argue that they're actually under more pressure around funding should also fall away. So there is that positive to it. We have started to see that the overall corporate bond market in the US is starting to ease. It's not as tight as it was. It's certainly cheaper to borrow money in the US than it was this time last year. So that's what it means from an Australian perspective. The ability, therefore, for your mortgage to be lowered should be increasing as the banks see that pressure. It also, therefore, means that the US investor can start borrowing money easily and therefore taking it overseas and investing it overseas, Australia being a case in point. The Americans are very good investing in this country, and that is also a positive thing to be sort of put out in another way.
Okay, Evan, so by that measure, do you think the RBA then strikes a line through the potential of another rate cut this year?
It's growing that way. I mean, yesterday's CPI was a little bit all over the place. The headline figure was better than expected, but they look at what we call the trim mean and the weighted mean, and that was at 1.4%. So that is low. It again showed random things were moving at different paces. The most moving thing was tobacco. Then you've actually got holidays, and that in itself is quite interesting. The worst thing that was actually out there in terms of its sales was things like housing, but also not normally the kind of place you'd expect. Electricity declined in terms of what it did in the last quarter. So it was all over the shot. The expectation is falling away quite rapidly. They've had 3 and 5 months. We have started to see things pick up in things like private investment. Capital expenditure is getting a little bit better. So 2019 looks less likely. However, wages still aren't there, and that has been the core discussion for them over the last 18 months. So maybe not this year, but early in 2020, still expectations are for a 4th rate cut to see us at 0.5 of 1%, a new record all-time low on the cash rate sometime before March.